Swayam Prabha. Digital India. Educated India.
Hello everyone, welcome to my lecture. So today we are going to talk about effects of taxations, in particular economics effects of taxation, and some of the discussions that we can also begin with the tax incidence, especially when tax is imposed on certain things, say commodity, then whether tax will be solely borne by one party or will be borne by two parties. And here when we are talking about parties, one is producers who produce the goods and services and the consumer who consume it. So let us begin with what are we actually talking about when we are talking about economic effects of taxation. So a couple of discussions and the definitions that we already began in our last lecture. So today we are going to talk a bit more on in terms of how we calculate taxation from the income, and we also discussed in our last lecture whether taxation or tax will be levied on income or it should be imposed on the consumptions. And we know that from the macroeconomic equations, like y, which is output is basically the function of total consumptions and the savings. So here in a way savings is coming in the picture when we calculate present discounted value of consumption and also the income. So to understand the measurement components of tax calculations, and we can actually take this example like from the income approach that we already discussed. Like income is considered is one of the efficient measures to consider while calculating taxes. So in the gross income, if we consider gross income, then what are the deductions that we have? And if you remember that we already discussed, like in general, workers or employees who are working for the organizations as a regular or under some of the contracts, in the pay slip becomes very important, and in the pay slips income component and also a deduction component should be clearly stated. So income component should also be included in terms of incentives and also the overtime. For instance, if we take the example of say workers in the factory, and then deduction, like what are the deductible components are there in that particular pay slip or in that particular job, that also has to be clearly stated. Once we know that income, while calculating income and taxes, then we really need to clearly understand how deduction takes place. So when we talk about the fairness of the taxation or tax calculations, so this becomes very important, the declaration, like what are the components under which we are actually deducting, or we as an employer, how employer they are deducting different deductions, including standard deductions or some of the components, like we'll give you example in a minute. So these are the components that we really need to understand. So we also discuss like direct taxes, especially targeting the workforce, active workforce, and the revenue tax collection or tax revenue collection from the direct taxation. That also gives very clear picture, like how much definite tax revenue that we can collect it through direct income, and that also shows that how people are eligible, as well as how people they are able to pay the taxes. So gross income, and then if we minus all the deduction that we are referring here, then we get the adjusted gross income. So these are the methods that I'm talking about. It's just to keeping a lot of examples from all over, including Indian case. So it is not specific for any country. So generally, and it may also vary. So generally we try to first get the gross income, and then from gross income we get the adjusted gross income, and then from adjusted gross income we also try to exempt certain components, like for example fixed amount deduction on dependent, and also standard deductions, for example gifts or charity or something that is there. So we at the time of tax filing we also see that even in our salary there is a standard deduction. So this is like the exemption that we kind of get it. So once we deduct the standard deductions from the gross income, so gross income, and then we have to deduct, and then we get the adjusted gross income, and then couple of standard deductions, and then it becomes a taxable income. And then if we kind of after taxable income, if we deduct the different credits like spending on childcare, educations, and then we get the total tax payment that we spend towards the taxation process. So this is just one way how arithmetically we calculate tax from the income component. So now let's move to two more concepts, and the first one is of course the tax rates. So that is how individual taxation and also average that comes. So the first point is like marginal tax rate. This is the percentage that is paid in taxes of an additional amount earned. So we know like per unit income, like if my income is increasing from Y1 to Y2, and if it is increased, then of course due to change in one additional unit, like one additional unit of income, what is the impact that is happening on the taxes? So what is the changes in the taxes? That is what we are trying to understand. This is precisely changes in the total taxation due to one unit changes in the income is referred as marginal tax rate. So now let's talk about what is average tax rate. So the percentage of the gross income that is paid in taxes. So in the percentage of the gross income, when we are talking about, so it is basically in the proportionate, like, and then what is the average. So this is the average tax rate that we consider. So in the taxation we have been talking about one of the component that is very important when we design the taxation or whether we formulate the taxes while calculating tax revenue. So one point that comes is the fairness. It is on the fairness. So when we talk about fairness, is equity and taxation or taxes are important component. So let's talk about two things here. So one is vertical equity, the other one is horizontal equity. So let's begin with the vertical equity. So what do we mean by vertical equity? The principles of the vertical equity that groups with more resources should pay higher taxes than the groups with the fewer resources. I think we have been talking about, we are giving this example with regard to types of taxation like progressive taxations or regressive taxation. So here like higher income group should pay higher taxes, higher wealth or elite they should be paying more taxes, and then the producers who are having higher profit proportionately they should actually pay higher taxes. So these are the examples in context of vertical equity. So in the vertical equity there are three broad categories. One is progressive vertical equity, which says that tax system in which effective average tax rate rise with the income. So here we are trying to highlight average taxes, like proportionately it should be increasing. Proportional, the tax system in which effective average, again average tax rate, do not change with the income, so that all taxpayers pay the same proportion of the tax of their income in the taxes. So here is just the tax that we spoke about, like total government, say total government expenditure. So total G will be equally treated as capital T, and T is the total tax revenue, and whatever the total number of population that we get, like say capital N. So these are the examples that we also discussed in our previous one of the previous lectures. So when we get the total expenditure from the tax revenue, and or with we can also say in other way, like when we know what are the government expenditure that is required in the economy, and that amount of the government expenditure can be called as total tax revenue. And then total number of populations that we have, so total tax divided by total number of populations irrespective of their income groups, that has to be, and that will be considered as proportional tax rate within the vertical equity structure. So now the third point is a regressive, the tax system in which effective average tax rates fall with the income. So it is not proportionality, and this is also like some elites, some elites or higher income group will be having some tax exemption, and as a result of which that those higher income group or the elites, they will pay end up paying less taxes. So it is basically regressive tax taxation process. And then we can also see that poor people or lower income group sometimes end up paying more taxes. So this is definitely, it is not proportionately, and then this is this can be referred as regressive taxation process. So now in the horizontal equity, it means the principle that similar individual who make different economic choices should be treated similarly by the tax system. So one can take the example like any community should not be discriminated based on the color or based on the caste or based on the class. So this is like irrespective of their social identity or social groups. So individuals will pay the taxes accordingly. So this is what the point that we discuss when equity and taxes discussion come together. And then here definitely we are talking about the fairness while talking about the taxation process. So let's move on. So this is Haig and Simon's comprehensive income definitions. Just to kind of summarize that what we understand taxation, and we are considering income is a basis on which taxation will be calculated or taxes will be calculated. So basically this income definition, it was first advocated by German legal scholar George von Skans, and his concept was further developed by American economist Robert M. Haig and Henry C. Simons. So they actually define and then try to give some algebraic form of taxation which is based on the income. So what was that? It is defined taxable resources as an individual's ability to pay taxes. Quite similar philosophy that we already discussed, like why should we consider income, because or should we consider consumption. So consumption is definitely, sometimes I agree with the fact that even for the income measure, it is better to consider consumption, because consumption expenditure gives much better clear picture in terms of income calculations. And especially this is applicable for a country like India, where share of the informal sector in the workforce it is quite high. So in that case I agree that consumption could be one of the efficient method of calculating say for instance income or poverty. So here in case of taxation, income can be considered, and this is like the argument that was built, like income can be considered because income gives or shows the picture like who are able to pay, and then ability to even pay taxes that particular point. So Haig and Simons, they also kind of argued on that, and then this ability to pay is equal to, so this is important, ability to pay. And if you remember in our macroeconomics elements or elements under macroeconomics in the public policy debate, we spoke about marginal propensity to consume and marginal propensity to invest and also marginal propensity to save. So when we are talking about the ability to pay is basically the propensity to pay, or whether they can or workers or any group or the consumers, whether they can make the effective demands for any goods and services. So some people who are able to pay, so we are considering that is equal to individual and individual's potential annual consumptions, the individual's total consumption during the year plus an increase in his stock of wealth. So here certainly when we are talking about taxation, and if we are considering say income as a measure or methods, then certainly consumption will be there as a part of the calculations. At the same time, the stock or stock of wealth will also be considered, because that is also one of the sources of the income which gets added to the person's total income, and then when tax will be calculated based on that. So if we combine these two, especially the income, then this is what Haig and Siemens definition of the taxation from the resource allocations point of view is like capital Y, which we are already familiar, is the output or income of an individual, is equals to consumption, total C, consumption expenditure plus net wealth that we have, and then that changes in the net wealth. So that is how total income will be calculated, and based on which total taxation will be calculated, whether we follow vertical or whether we within vertical, whether we follow regressive or progressive or proportional taxation, right? So this is how we actually kind of sum up the discussion on the taxations and income together. So now let's move forward. So tax incidence becomes very important context, and especially as a student of economics, we should be knowing like how tax burdens are there, who are bearing the taxes, where it should be imposed, whom are the people, like who are the people who should be taking care of this particular taxes, and who should bear the taxes. So that is the first question, and as a student of economics, we should be clearly able to answer to those questions. So when we talk about tax incidence, so let us first discuss about what is tax incidence, or incidence of a tax refers to who actually pays the tax, that is who has their income reduced by the tax. So obviously if you recollect, we are actually referring to that disposable income, right? So the income that we get, we should not be happy about it, because that is a gross income. So all the liabilities, expenditure liabilities should be deducted, and before expenditure liabilities, one should be really careful while calculating expenditure or list of expenditures. It should not be based on the gross income, it should always be based on the net income, which is like after the deduction of the taxes, after deducting all the standard deductions or all the exemptions that one has in their pay slip or in their income. So when we are talking about disposable income, we are actually talking about total income and then minus total tax. So once we get that, one can refer as a net income. So when we get the net income after deducting the taxes, and then that is what the burden incidence of the tax that we are actually talking about. So there are two ways in which we can actually understand incidence of a tax. One is statutory incidence, the burden of tax borne by party that sends the check to the government. Like if tax is imposed on the commodity, and then it will be the check on the tax will be transferred by the producer to the government. Or if tax is imposed on the commodity and on the consumers, then consumer is liable to pay the check to the government. So this is the statutory kind of tax incidence. The second one is economic incidence. So burden of taxation measured by the change in the resources available to any economic agents as a result of the taxations. So it is basically marginal rate of tax or marginal tax rate we are talking about. So it is basically the burden of the taxation that we are talking about. So when we talk about tax burden, there are couple of points that we are supposed to remember here. The tax burden is the difference between individuals' real income before and after tax has been imposed, taking full account of changes in relative prices and the wages. And it is true for weight of a tax. So that's how economic burden will be defined, like who is bearing and how much and what is the weightage of the bearing the tax. So this is called tax burden. Those who bear the burden of a tax may differ from those on whom a tax is imposed or levied, and basically this is statutory incidence that we are talking about. So the inelastic parties, like when we are talking about whether elastic or inelastic, bear the taxes, while those with elastic demand or supply avoid the taxes. So let us refresh our idea of price elasticity of demand, and especially say let's take example of demand, price elasticity of demand, and you can take the example of say inelastic and relatively less elastic. So when we talk about elasticity, so let's draw, and this is certainly clear case of the relatively elastic goods, and this is the second drawing. It is clearly example of the relatively highly inelastic. So if we consider P is a price along with the vertical axis, and Q quantity demanded on the horizontal axis, and in P we can actually consider as a tax, like say tax, for example, tax as a price, so or tax incidence. So here we can see smaller changes of the price is actually creating higher changes in the quantity. Likewise in the say here in the second diagram, 1 unit of changes in the price is actually marginally impacting on the quantity. So from taxation's point of view, we can see like higher tax imposition on the taxes for the in case of inelastic inelastic parties, then higher changes in the price is actually impacting a very small effect on the quantity demanded, unlike in the elastic. So therefore inelastic parties, whether it is demand or supply, they will bear the taxes, while those with the elastic demand and or supply avoid the taxes. So this is what elasticity's debate. Also we can actually think about tax burden and tax incidence. So now shifting of the tax, when we impose tax or tax is levied, then how one can actually shift. For instance, the process of transferring tax, while its impact lies on the persons who pays initially, or shifting the process through which a taxpayer escape the burden of the taxes, is basically transferring the burden to the others. The point or the example that I have given, like if tax is imposed on the commodity here is like say on the producers, then say producer will not bear alone the taxes. Producer generally the tendency will be to transfer this on to the workers or on the consumer through the production, through the commodities. So one is forward shifting. If the prices rise, we say that tax shifted towards to consumer, passing the tax burden to consumer through the higher prices. So that is a forward shifting, like simply worker will increase the price of the commodities, and that's how producers will actually recover the taxes that that producer has given as a check to the government. The other one is backward shifting. If for example if wages fall, we see that tax shifted backward. The burden is passed on to the suppliers or the workers, often through lower prices or the wages. So this is what we call, if tax is imposed on producers through say through commodity, and then it is actually not passing on to the consumer, it's not a forward, but then it is actually passing on to the workers through the wages, and if wages is getting reflected on that, like no increment for instance, so that will be considered as backward shifting, that producer is trying to kind of adjust the tax or kind of escape the tax burden through internal adjustment through its cost of production. So that this is how tax shifting happens broadly in two ways. So three rules of tax incidence that we talk here. So so one is the statutory burden of tax does not describe who really bears the tax. For example, petrol and diesel taxes, like if taxes are on petrol and diesel. So first is legal incidence. So oil marketing companies collect the tax and remit to the government. So it is basically the check that company will collect, and then check will be given by the company to the government. The second is point like economic incidence that we really need to understand. So our main focus is here, like consumers bear most of the burden because demand for fuel is inelastic. So this is very important, like what kind of commodities that we are talking about. So here it is inelastic. So really, I mean, if price increases, it is not like that particular commodity becomes expensive for the necessary commodities, then certainly consumer will not stop buying that commodity. Like here, if we consider diesel or petrol, so even it is increasing, then certainly there is a very less impact on the commodity consumed, and therefore this is inelastic. So people cannot easily reduce consumption even its price rises. So this is income, like economic incidence. It is impact on the consumer's consumption and also consumer's income. So this is what we call statutory, is the first part of it. Then again, one can also take another one example, the GST on restaurant or e-commerce deliveries. That this is like ongoing debate. Like legal, again here we can take the two examples. One is legal incidence, that business collect GST and pay it to the government. For instance, even Ola and Uber drivers, they also pay the GST, and we as a consumer who actually take the ride, we also pay the GST, and that's how company will actually collect from consumer, like from us, and also from the drivers, and then consumer actually, I mean producer or the business companies, they will actually calculate and then they will pay the taxes to the company. So it is basically who is actually bearing the burden and who is collecting. So if you recollect in our earlier lecture, we already discussed about organization effects and also financial effects. So the moment we decide, like Ola or Uber for example, as like one of the companies, that example that we had taken. So if Ola and Uber has decided that they will collect the taxes from consumer and also from the drivers, and then they will pay, and then the entire tax structure, it is different. It is not government has imposed on us like on every ride that we have to pay from the income. It is not on our design on the income. It is actually designed on our consumption of the goods and services. So in this particular context, legal incidence that we can actually think of, and this particular point on the legal incidence we can actually also understand from organizational and financial effects, not from behavioral too much, because here organization like Ola and Uber are deciding how to collect the taxes through GST and then pay the check to the government. And economic incidence here is like passed on to consumers through higher menu prices, like for example in case of restaurant, or delivery charges, which is like directly impacting on the income or the earnings of the delivery boys or say Ola and Uber drivers. So tax incidence can also be discussed here. The second point, the side of the market on which tax is imposed is irrelevant to the distribution of the tax burden. So market also decides on that, like how much, and then equilibrium level or the prices gets decided, and that's how tax also will be kind of decided. The parties with inelastic supply or demand, I'm just reiterating because this comes as a rule, bear the burden of the tax. So this inelastic is very important, and one can also try to understand inelastic point of view from the essential commodities or different types of commodities, and then actually different types of commodities will define or will help us to understand how we should actually pay the taxes to the government, or whether it should be it will be forward shifting, or it will be backward shifting. So here inelastic and elastic means types of commodity actually finally will decide how tax incidence will take place. So for this particular lecture I have used the two basic texts that I have shared. One is by Joseph Stiglitz, the other one is by Jonathan Gruber. So in this particular lecture, the initial discussion on the taxes like different types of taxations, and also how we calculate, and then initial debate of the tax incidence I have used from Jonathan Gruber. So I will stop here, and then I will see you in my next lecture, and we will continue this discussion further with different types of market that we have. So thank you very much for your attentions.